So you want to start investing, but have no idea how or where to start. If that is the case, you have stumbled upon the right video. I have once been in your place and know how it feels not to understand what exactly you're supposed to base your investments on. So I made this short video to help you fully grasp the basic ratios and statistics you must understand if you want to become a smart investor and make money. To make a smart investment that will grow your profits year over year, you must be able to evaluate the company you are buying. Therefore, today I will show the 8 most important statistics you must consider before buying a company's shares. The first key statistic worth evaluating is the company's 5-year PE ratio, or price per earnings over the last 5 years. 5-year PE ratio is the company's market cap divided by its total profit over the last 5 years. But how does that provide me with any useful information? Well, in simple words, as an investor you want your company to earn as much as possible in comparison to what they are worth. Therefore, when you divide the company's market cap by their profit, the lower the ratio you get, the more profitable the company. On average, a ratio below 22.5 is considered good for a 5-year margin, while for a 1-year PE the ratio should be below 17. This is because when calculating a 5-year PE ratio, we want to account for growth of the company. The second statistic an investor should evaluate before buying a company's stock is the profit margin of that company. Profit margin is calculated by taking the company's net income over its revenue and multiplying by 100 to get a percentage. That percentage accounts for money a firm gets to keep after all its expenses and liabilities are subtracted from its profits. Generally, a profit margin of 10% or more is considered good, but that depends on the sector your company of choice is in. The third statistic you should consider is the company's revenue growth over the last 5 years. Revenue growth shows an investor whether a company is increasing its revenue year over year. Generally, an investor likes to see growth in their company's revenue as it tells them that the company is growing value and therefore growing their money invested. The fourth statistic is profit growth, which is very similar to revenue growth. The difference between revenue growth and profit growth is very simple. Revenue is the money a business made before it subtracted all its expenses, while profit is the money a business made after subtracting all its expenses. Both are important, but generally, profit growth is more important than revenue growth as it gives a more accurate picture of a company's financial status. The fifth statistic you should look at is the change in the number of shares outstanding over the last years. So why does the number of shares outstanding matter? Well, let me give a simple explanation. If you own shares in a company and the company sells out more shares to other investors, the percentage of the company you own will gradually decrease year over year. This goes the other way around as well though, and so if a company decreases its number of shares outstanding, your ownership of the company will gradually increase. Therefore, you want to look for companies that have been lowering their number of shares outstanding. The sixth statistic you want to evaluate is the company's current assets compared to its current liabilities. So what are assets? A company's assets can quickly be liquidated and turned into cash. Things such as real estate, bank balance or inventory. On the other hand, the company's liabilities are essentially its debts. Therefore, it is safer to invest in a company that has at least the amount of money in assets to cover most of its liabilities, ensuring that the company won't go bankrupt easily. The seventh statistic we are going to cover today is the increasing free cash flow over the last 5 years. But what is free cash flow, you ask? Well, essentially, free cash flow is the money obtained from the company's operations and represents the money available for paying for dividends, share buybacks, or just the company's growth in general. When a company has increasing free cash flow, it means that they have the ability to expand and keep up with the market. The eighth and final statistic an investor should consider before buying a stock is for the price to free cash flow to be below 20 over the last 5 years. Price to free cash flow is calculated by taking the market cap and dividing by the average of free cash flow values over the last 5 years. If the ratio you get is higher than 20, the price of the stock you want to buy is overvalued. If on the other hand the price is lower, the stock is undervalued, indicating that its price might go up in the near future. And there you have it, the 8 major ratios a smart investor should consider before buying a company. I would highly encourage you to watch the video one more time to really grasp the understanding of the 8 statistics, as they are crucial to evaluating the stock market movement. But also do not forget that there are many other factors that can influence the course of your investment, and following these 8 statistics does not mean certain investing success. With that, thank you for watching and make sure to like the video if you found it helpful. Also, if you'd like to see further videos that cover every ratio separately and in more depth with examples, let me know down in the comments.